When things are going really well, there's a natural tendency to think it can't last, especially when the good times last longer than you ever thought possible. That seems to be the situation we're in now. Fantastic returns for investors for 3 years? Surely it can't last. And you're right, it can't last, and you'd be crazy to think it can. After all, the three most important economies for Australian investors, Australia, United States and China, are all going into a slowdown. And that's because the monetary authorities in those countries are making sure that they do. But I don't think there's anything to be afraid of in that. Earnings growth might be a little harder to come by, especially for banks and consumer businesses, and commodity prices might stop rising, at least at the pace that they've been going up, so that mining companies might struggle to double profits again. But even if the return from the share market next year is, say, 10%, that would still be a great result after a 4-year bull market that's rewarded us with more than 20% a year total returns from the share market. A fifth year of 10% returns, based purely on earnings growth, with PE staying roughly the same, which is what I think is most likely to happen, would still give us a 5-year average return of close to 20%, which is still a wonderful compound return. And if we get through the next year without recessions in the US and China or Australia, and the Reserve Bank of Australia and the Federal Reserve of the US start cutting rates around mid-year, which is also what I think might happen, then there's no reason to suppose that 2008 won't be another fantastic year. Here's what the new Reserve Bank Governor, Glenn Stevens, said while announcing the 8th straight increase in interest rates in November this year. The world economy has grown strongly in 2006 and is expected to grow at an above-average pace in 2007. Although growth in the United States has moderated recently, strong conditions are prevailing in other parts of the world. The global expansion has contributed to high levels of commodity prices, which continue to add to incomes and spending in Australia. So my core prediction for the Australian economy is moderate growth in GDP, around 2%, with a rate cut around the middle of the year. The drought is biting and will reduce GDP by 0.8%, or perhaps a bit more. Australia does have a two-speed economy, as we keep hearing, and New South Wales is in fact toying with a recession, but it won't have one in my view. And also Queensland and WA are having booms, but those booms will end, although with unemployment at such low levels, there's no reason to think there'll be anything other than a soft landing. The most important thing is commodity prices and commodity markets, and therefore the US and Chinese economies. Right now there's a two-tier economy operating in the US as well. Housing and the automotive market, Detroit, are in recession, but the rest of the economy is going along really well. In my view, neither of those two US recessions, housing and automotive, is likely to be that much deeper or that much longer than it has been already. And therefore, the effect of them on the US GDP is likely to be about the same as the Australian drought, about 0.8%. Meanwhile, consumer demand in the US is being supported by the lowest unemployment rate in a generation, 4.4%, falling petrol prices, and falling and low long-term interest rates, leading to low mortgage rates. As the housing market bottoms early next year, as I believe it will, then the resilience of consumer demand will start dominating the news. And that'll raise the questions, of course, about the timing of any Federal Reserve rate cut, although I think that'll come about the middle of the year. That points to a strong performance by the US stock market, particularly the big cap companies that have been performing so poorly over the last few years and have had such low valuations. That's likely to provide some support for the Australian stock market, by the way, but I would expect the US market to do better than the Australian market next year. A lot depends on China, where the People's Bank of China has been trying to cool off a red-hot economy. So far this year there have been 3 increases in bank reserve ratios plus 2 rate hikes, but investment spending is still rocketing along at 15% a year. You must expect that the Chinese authorities will redouble their efforts to slow the Chinese economy down and prevent a massive overhang of excess capacity, just like what happened with Japan in 1989, which led to 15 years of deflation. The Chinese government will do whatever it takes to prevent the Japanese scenario occurring in China, and even if that means slowing down investment and slowing the economy down. That'll probably mean more interest rate hikes in China next year and a moderation of demand for raw materials. So while that means commodity markets might plateau next year, it'll produce a much more sustainable future for commodities. So while I think there's likely to be a slowdown in global economic growth next year and a moderation of the extraordinary investment returns we've seen over the past 3 or 4 years, I think it'll be the pause that refreshes. the longer term outlook for investors is still tremendously exciting.